How frequently do you check stock prices of the stocks you have invested in the stock market? Do you check daily, weekly, monthly? How frequent? And I'm asking that because in this video, I want to discuss why it is a bad idea for you to be checking the prices of stocks every day or even multiple times a day with the aim of you altering your position. In case you are checking passively just to be informed, that is okay. But if you are actively monitoring several hours a day with the aim of you changing your position, that is probably a bad idea. That is what I'm going to be focusing on in this video. In case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos each and every day about money and investing. If you love these topics, down there is a button called subscribe. Click that button to subscribe to join my channel for you not to miss any of my future videos. And while you still at it, drop a like on this video. Thank you for subscribing and also liking this video. Having said that, the very first reason why you shouldn't be checking prices of stocks each and every day is because daily price movement are mostly noise. What do I mean? Prices in the stock market are driven by sentiments, okay? And based on that, they have little to do with company fundamentals because the company fundamentals dictate the true value of any stock. So, when you have a bunch of noise traders, and unfortunately, in the stock market, the majority, upwards of 95% of traders are noise traders. If you have a majority of noise traders having different sentiments, it's going to mean there's bound to be some volatility, okay, on the stocks. And if there's volatility and you are reacting to that volatility based on which is driven by sentiments, news, vested interest, and so forth, probably you might be making the wrong decision. Reason being, short-term fluctuations are normal and shouldn't be the basis of you deciding long-term investing decision. Your long-term investing decision would rather be determined by the true value of a company. And then the second reason as to why it is a bad idea for you to be looking at the stock prices daily is because it leads to emotional investing. And as an investor, this is one of the biggest dangers you need to avoid, emotional investing. Look at this scenario. If you are sitting there looking at the prices of stocks every hour, every 30 minutes, whichever fluctuation is happening is going to drive you to invest emotionally and make a bad decision. Case in point, in case the price is dropping, maybe it's dropped the past 30 minutes or 1 hour, it's going to trigger fear. You might want to go short with the fear that the price is going to continue dropping, okay? And in case the price has just risen a little bit, it might end up triggering greed, making you want to go long on that very stock, thinking that is going to be sustained. That is why you need to avoid looking at prices of stocks every day or even multiple times a day, because controlling emotions is a key thing and a big player on how you do fare in the stock market. Because successful investing requires discipline, requires strategy, not reacting to every market movement based on how you are feeling. And then the third reason as to why you don't need to be checking the price of stocks every day is because you checking is going to pull you in or encourage you to do what is called overtrading. Sometimes once you take a position, the best thing to do is to do nothing. Now picture a scenario where you are sitting there, okay? You are watching the prices constantly. There is movement in the market. As a human being, you'd want to take part in that, right? You'd want to do something. You'd want to even in case you're not touching those stocks you've invested in, you might want to touch other new stocks. Reason being, you are idle. You are looking at the stock market frequently. The best thing sometimes to do is to do nothing. Once you've already done your own research, you've taken a given position, you have your investment goal, you stick to it. You don't need to be looking at the prices because that might pull you in to overtrading, which typically ends in losses. And then the fourth reason as to why you shouldn't be looking at the stock prices every day is because, let's face it, guys, even great companies have bad days. And also that goes for individuals. You might be a great person, but to sometimes have the bad days. That also goes for companies. Even great companies have bad days where some things might happen and affect the price of their stocks. It doesn't mean it is impacting their fundamentals. It doesn't mean the stock of that company is bad. It just means they are having a bad day, which might make the price of their stock to drop. That doesn't mean the company is bad or it's veering off from its fundamentals. And that is why if you are sitting there glaring at the charts and the company which you think is quality company maybe is having a bad day and the price has dropped, it might send you to overtrading or even draw you into reacting, which shouldn't be the case because patience typically allows investors to benefit from long-term growth as opposed to chasing short-term market sentiments. The other reason as to why you shouldn't be looking at the price of stock markets and stocks every day is because constant monitoring increases stress in any human being. You sitting there looking at the prices fluctuate is bound to create unnecessary anxiety and unnecessary frustration. You are better off doing other things. You are a busy person. Focus on other activities of daily living instead of looking at the stock market because regardless how strong you are, looking at the charts regularly is bound to trigger stress. And stress, guys, is the basis of people out there making impulsive decisions. You might say you are extremely strong, but then again, if you are glaring at the charts, it causes anxiety, it causes you stress that will send you to impulsive decision making and even end up taking positions which you haven't done research about or even affecting your existing positions because of you glaring at the chart. And then the sixth reason as to why you shouldn't be looking at the stock prices daily is because you looking at the stock prices really distracts you from the most important thing. It distracts you from what really matters. For any investor out there, the fundamentals have a very big impact on their investment returns compared to the sentiments in the market. You looking at the stock prices, you are spending time on guesstimating sentiments which are beyond your control. You'd rather spend your energy and time looking at the fundamentals, basically trying to understand revenues of that company, trying to understand profits of that company, trying to understand cash flows of that company, trying to figure out the competitive advantage of the companies you've invested in. That is a better use of your energy as opposed to you trying to make sense of sentiments. They'll never make sense. So it is better to focus on the fundamentals, and then that is going to enable you make informed decisions on those standing cadences when you decide to make informed decisions in a stock market, like purchasing or disposing or basically going short on any position. Think like a business owner, don't think like a daily trader because that is the easiest way for you to hit big losses in the stock market. Okay? And then the seventh reason as to why you shouldn't be looking at prices on a daily basis at the stock market is because you may miss out on the power of compounding. Guys, the real magic in people growing the value of their investment, seeing that investment increase exponentially, is in something called compounding. And compounding works with you investing and then obeying time horizon. Simply put, long-term investing works magic when it comes to compounding. If you are looking at the stock prices each and every day in a given stock market, what exactly are you looking for? Right? Even if you are very strong, at some point you'll alter your long-term position. And it is through long-term investing that a person is going to enjoy dividends, okay? And if they keep replying back their dividends into their investment, that is when the real magic of compounding kicks in. They're going to see that investment increase exponentially because of their long-term investing decision, which, by the way, you can't stick to in case you are looking at the prices of stocks each and every day. And then the eighth reason as to why you shouldn't be looking at the prices of stocks each and every day is because media or news highlights can really mislead you big time. What most people out there don't understand, and I really think investors out there need to know, is that media headlines are typically anchored on being sensational. They need to make their headlines very punchy, sensational for people to click and try to read to see what makes sense, or even to listen to that particular piece of news which is coming from a given media house. That is why sometimes media headlines can mislead you. Something whose fundamentals is very different might be reported in a way that is very sensational, and it might make you make a bad decision. And by the way, if you didn't know, you need to understand also how media out there makes their money. A good chunk of media out there makes their money through clicks. Simply put, they need to ensure something is very sensational for somebody to click it. Once they click it, they're going to sell them the adverts, which different bidders are bidding behind the scenes. When they sell them these adverts, then they are able to make their revenue. Basically, they can make money. So they're going to most at times strive to ensure they have very sensational headlines, which could be misleading because they're going to most likely be anchored on fear, creating anxiety, creating uncertainty. And if you're going to labor your decision making on these sentiments, be sure you'll end up making wrong decisions if you're just relying on news to decide your position in the market. And then the ninth reason as to why you shouldn't be looking at the price of stock each and every day is because history has already proven that successful investors rarely watch the prices of their stocks regularly. This is already proven. Successful investors do invest long-term mindset, okay? They are typically patient, okay? They are investing after they have understood the business where they put their money down on. And they make their decisions based on studying cadences when they do comprehensive reviews of their portfolio to drop stocks which are not working and to acquire new stocks to bolster their portfolio. They don't make single decision-making points based on sentiments. And this is already proven in history. People invest long-term, even 20 years, 30 years, for them to really realize the benefit of compounding and seeing the business which they invested in, which they are thinking were quality businesses, truly give them the desired returns. That is why it is good to learn from history. And then the 10th pointer for you is a bonus. Having shared those 9 reasons as to why you shouldn't be looking at the prices of stocks each and every day, the bonus pointer for you, which is point number 10, is that maybe if you are sitting there looking at the stock prices each and every day, you have a gap in your investing approach. You don't have a routine which you've established for yourself as to when you need to be reviewing your portfolio. Is it quarterly? Is it biannually? Or even is it annually? Because I'm very sure if you have a portfolio, your routine analysis, you don't have anywhere in your goals that says you're going to be reviewing your portfolio on a daily basis. So think about having an established cadence for when you can be reviewing all these things, doing the trend analysis to understand the prices, basically looking at the technical analysis and charts, you name it, and also doing fundamental analysis in depth to understand the business health. Then you make an informed decision for any alterations you need to do to your portfolio to be able to enhance your position. Have a standard cadence which is going to assist you operate on a routine as opposed to you looking at the stocks daily and moving blindly. You need to have a routine, and that way you'll operate in a very sober way in the stock market because you'll spend less and less time watching stocks because either way you won't take an action, and instead spend time at the appropriate time studying the market, understanding fundamentals, and using the knowledge you have acquired to be able to make better informed decisions within those regular routine review periods you set for yourself. Guys, what do you think about this video? Do you agree that reviewing stock prices on a daily basis is a waste of time and not a good idea? Or do you still hold that you're going to continue reviewing the prices of your stocks each and every day? Comment down below. Let's continue discussing. Cheers, guys. Look forward to catch up with you in the next video. Bye-bye.